A very warm good evening to one and all present here. At the outset, I would like to thank you, Direct Tax Committee, for giving me such opportunity and thanking them to organize such seminars when there is an urgent requirement of the same. To start with, I would like to introduce the chairman of the Direct Tax Committee, CA Piyush Chhajed sir. He is a senior partner at Chhajed and Doshi Chartered Accountants with 25 years of professional experience. He is former and current Central Council member and chairman of key ICI committees, including direct tax, serving multiple key committees. Others. He is recognized as an expert in tax advisory and tax litigation with contribution to national and international policy bodies. Regular contributor and reviewer for tax publications, sharing expertise through articles, reviews, and professional knowledge initiatives. Actively engaged in governance and social work, serving as independent director and trustee with several organizations. With this, I welcome him with a big round of applause and request the chairman of the committee to give his brief
I
remarks.
think Vishnu
Over to
Bhai
you,
would,
sir.
you can introduce Vishnu ji. He would like to speak here today.
Okay. Okay. To proceed further, I will like to introduce the Vice Chairman of the Direct Tax Committee. He is a Central Council member of ICI 2025 to 2029 and Vice Chairman of key ICI committee including Direct Tax and CP committees. Specialist in income tax matters with expertise in litigation, search survey proceedings, Benami and black money laws. Renowned author and speaker, delivering sessions across India and authoring acclaimed book Landmark Judgments of Income Tax. Had major leadership roles, including WIRC chairman in 1718 and served 3 terms of WIRC Regional Council. He is dedicated to community service, actively involved with multiple social and cultural organizations. With this brief introduction, I would like to welcome with a big round of applause to the Vice Chairman of the committee, CA Vishnu Kumar Agarwal, sir, and will request for his brief remarks. Over to you, sir.
Our Honorable Principal Commissioner of Income Tax, Vijayji from Delhi, our Chairman of the Direct Tax Committee, and my elder brother, CA Piyush Chhajed, today's learned speaker, CA Prerna ji, and the Managing Committee member of the Nagpur branch, CA Ashish Agarwal ji, today's moderator of this session. I welcome all of you in today's webinar on the TDS and TCS on the New Income Tax Act 2025. Friends, this is the first time when ICI, along with the Direct Tax Committee and the Income Tax Department, jointly doing the webinar for the Income Tax Act 2025. And this is the fourth series today on the TDS and TCS. In total 8 days, we are doing the Income Tax Act 2025 on the discussion. We are happy to discuss, happy to share that the Income Tax Department himself he joined hand with the ICI to doing this webinar across the country. Sir, we are doing the physical program also and the webinar also across the country. This from our ICI platform from Delhi, we are doing this webinar, and across the country we are doing the physical program for the new Income Tax Act 2025. The APJ Abdul Kalam is always says that ICI is the nation building partner. So in that direction, again, sir, we are doing the so many programs for the Income Tax Act 2025. With this word, I again welcome each one of you for the income tax this today's webinar for the TDS and TCS. Thank you, friends.
Thank you, sir. Thank you for your words of wisdom. I will request the chairman of the committee to give his brief remarks.
Thank you very much, Ashish ji, for your brief introduction. Very respected Principal IRS, Principal Commissioner of Income Tax, Vasanta ji, thank you very much for joining us this evening. The technical speaker, CA Prerna Peshwari, and moderator and coordinator for this event, CA Ashish Agarwal ji, thank you very much. And a very good evening to all the participants today who have joined us on this 5th series of seminars only on Income Tax Act 2025. The idea behind this webinar series is to sensitize members about the reforms which are going to come through this Income Tax Act 2025. And the topic today would really make you believe that a great effort has gone into this Income Tax Act 2025. And why I am saying this? Because I am aware I was involved as a part of Institute of Chartered Accountants of India, as a chairman of Direct Tax Committee since July 2024, when the first time Finance Minister announced that we will do a comprehensive review of Income Tax Act. And since then, we were always involved with CBDT, wherein we did give our suggestions before the bill came in, after bill came in. Also, we gave our suggestions to the CBDT, as well as we presented our suggestions before the Select Committee of the Lok Sabha. After it became into the act, we have already again given our suggestions through pre-budget suggestions, and I'm sure once those suggestions have been accepted. But I could also put on record, even when the bill was about to come and when bill was getting converted into act, a lot of our suggestions have been considered by CBDT very positively. I've never seen in my 25 years of experience in direct tax that such a huge task has been done within the 4 months time. You just believe the finance minister announced in July 2024. I think so, if I remember correctly, somewhere in September 2024, committees started working upon that. And to come out with a comprehensive bill, a new bill completely, one may say that there are no major policy changes, but when you actually see TDS, TCS, Prerna speaking today, you will realize what huge efforts goes. And I can tell you, as a chairman of Direct Tax Committee, when I want to make a revision in guidance notes, and I make a team of 50 to 60 people, it huge efforts to revise it. Just imagine, Amit, yeah, sorry. So just imagine, for revising a one particular publication also, which is a guidance note on tax audit, which is always issued by BTC, it takes us 3 to 4 months time to come out with the new bill. It's an hats off effort to the CBDT and its whole team who were the members of this group. I know Vasanta Saab, you were also involved in drafting a lot of provisions, and I really appreciate that. But the buck does not stop over there. After the bill was introduced and when the act was coming, still they were open to the suggestions. They have considered each and every suggestions given by various stakeholders, including ICI, and also what were suggested by the Select Committee. And after the passage of the act, now they are already sitting and they are strongly working, I am sure, day and night, working on bringing in the rules, forms, and other necessary changes which have to be made to other allied laws also. So it's a huge effort. I'm sure the objective with which this Income Tax Act will be definitely achieved with the support of all the stakeholders, including our members. And therefore, I request all of our members, please see the efforts which have gone in. The objectives of this new act was to simplify the language, to bring in the provisions which will reduce litigations, to make it more concise. I believe that a lot of has achieved. Of course, time will tell when the people start discussing, when the judicial forums also look into it. But it's a real great, honest effort, which I believe the department, each and every person associated with it actually deserves a loud applause for that. So my personal congratulations through Vasantaji, I would like to put it before to all the members of the Income Tax Department. Of course, Prerna is taking a very important topic today, TDS and TCS. A huge effort has gone into it. I remember members never actually used to look into the law. They all will have a one chart on their table, which is pasted, and they always refer for the purpose of threshold limits, TDS, TCS. So you never used to read 194A, B, C. We used to go through the chart. This has been realized by CBT. They have tried to bring those tabulations in the act itself. You will see, I think so many sections ranging from 192, 193, 194, A, B, C, and so forth. And you will find only in two sections, 392, 393, or so and so forth. Of course, Prerna would be treating that within detail. But a great effort. So, Prerna, I think so, you will be explaining all these provisions, and it would be very useful for our members also in this particular case. So, to the members who are listening to me, please be attentive for next 2 hours. I'm sure it would be a very enlightening session. Thank you very much for giving me this opportunity. Once again, thank you, Vasantaji, for joining us. Thank you, Prerna, for taking up this technical session, and Ashishji for your efforts. Over to you, Ashish.
Thank you, sir. As rightly said by someone, that Indian income tax is one of the toughest thing to learn about, and tax deducted at source as itself means a tedious way, that is TEDIOUS, which is tough to understand and go further with. To proceed further, I will introduce our today's special person available with us from the department. He is a senior IRS officer of 2001 batch. He is presently Principal Commissioner of Income Tax TDS 1, Delhi, managing one of the India's largest TDS jurisdiction. He has 20 plus years of experience in tax administration, international taxation, policy formulation, litigation, and enforcement. He has played a key role in drafting the new Income Tax Act 2025, including coordination with legal ministries for review and implementations. Held significant leadership roles, including Commissioner International Taxation at ITAT Delhi. He has been a professor of economics at Lal Bahadur Shastri National Academy of Administrations and first secretary in London for treaty-related cooperations. He represents India at major international platforms, including OECD and G20 tax forums, bringing global insights into domestic tax policy making. With this brief introduction, I welcome and give a big round of applause to our today's person representing from the department, Shri Vijay Babu Vasanta sir. A big round of applause to you, sir. And over to you for your brief remarks.
Thank you. Thank you so much, Ashish ji. I feel very honored and privileged to be part of today's session. And I congratulate and appreciate ICAI, the Chairman Direct Tax Committee, Piyush ji, and Vice Chairman Vishnu ji, for taking up this arduous task of creating awareness among its members and the public about the new Income Tax Act 2025, which is to come into force from 1st of April 2026. That is less than 3 months from now. The Income Tax Act 2025, as you know, it marks a landmark reform in India's direct tax legislation. It's not a change in tax policy or the rates, but a structured and linguistic transformation of the Income Tax Act 1961, undertaken to make the law not only concise, lucid, and user-friendly, while fully preserving legal substance and continuity. Now, if you see the current act, the current act 1961, it grew from sections 298 sections over a period of 6 decades to over 819 sections, with nearly 4,000 amendments that was taken place. So the act has become very bulky with 819 sections. And if you see some of the sections like 234A, 234B, 234C, and the section 80 series, 80A, 80B, 80C, and 80GG, 80TTA, so on and so forth. So the sections kept on adding over this, 6 decades. It grew to 819 sections. So there is a need to simplify. And apart from this, there are about 1,200 provisos and 900 explanation that has been added. And if you see the section 10 alone has 90 explanations and 131 provisos. And if you see the subsection 23C, particularly of section 10, subsection 23C contains 35 provisos. And the third proviso includes 4 explanations. And the second explanation contains 8 provisos. There were provisos in clauses, explanation to these provisos, and again provisos to these explanations, making it extremely challenging to comprehend. So there has been a tremendous urgent need to make it more simplification, the simplification of the existing act. And many of the obsolete and sunset-based sections are still existing in the existing Act 1961, so which needs to be removed. Now, with this new Income Tax Act, what has been done? So one, the 1,200 provisos and 900 explanations, which I talked about, they have been removed and integrated into main provisions. And the obsolete and sunset-based sections, they have been done away with. And the numbering of the sections has been linearly numbered 1 to 530, 36 sections. And there are no suffixing like 80, IA, IB, and all that. They're just linearly numbered sections 1 to 536. And major provisions such as depreciation and significantly shortened at the same time with no change in effect. And all the definitions, the common terms, have been put up in a separate section, that is section 2. And the tax year, the concept of tax year has been brought in as a single unit of taxation, replacing the confusing dual concepts of the previous year and assessment year. And the salary exemptions and deductions consolidated. And as rightly said by Piyush, they use a number of tables, schedules, and formulas. They replace the dense narrative drafting wherever feasible, improving the clarity. And some of the procedural sections, for example, faceless assessments, these sections, they have been shifted to the rules rather than being part of the act. And there is a very strong saving clause, that is section 536, that is to safeguard all pending appeals, pending proceedings, appeals, and litigation for pre-2026 years to continue under the existing 1961 Act. So with this, what has been achieved? Now the number of words, if you compare with the existing Act and the new Income Tax Act 2025, it has been reduced from 500,000, that's about 5.12 lakh words, to only 2.6 lakhs. That is almost 50% reduction in the number of words. Of course, the tables have increased from 18 to 57. Number of chapters have decreased from 47 to 23. And the number of sections, as I said before, it has been decreased from 819 to 536. And the formulas, as I mentioned, it has increased from 6 to 46 formulas. So this has been the result of this the new Income Tax Act 2025. And if you see the TDS and TCS provisions, and they are the first ones to get impacted as on 1st of April 2026. So the importance of TDS and TCS has to be highlighted, because most of the other provisions, for example, related to the assessment and all, that comes much later. But these provisions, TCS and TDS, are going to be hit right at the first day itself, 1st of April 26. That's it's very important that we understand, we study, and create awareness about these particular provisions. And if you compare the existing Act and the new Act of these TDS provisions, the existing Act has got 3 parts, which has been reduced to 2 parts. And the number of sections, as PSG pointed out, the existing Act has got 65 sections dealing with TDS and TCS provisions. That has been reduced to only 13. 65 sections to 13 sections. And the number of words, because of this, has reduced from 27,500 words to about 14,500 words. Of course, the details of this will be dealt by Prernaji, the technical speaker, who will be speaking after me. And this could be able to do that because if you see the sections 192 to 196D of the existing Act, there are about 43 sections. These 43 sections has been consolidated and they're put in one tabular format in section 393. So these sections which deal with the TDS rates and all, they are much easy to comprehend, which are very user friendly, and it is much like a ready reckoner type of thing. So the major structural change has been made in this TDS and TCS provisions. And there's some policy, but there's one policy decision which has been made, which I would like to highlight, and which also we bring it in various outreach programs, is that the time limit for furnishing correction statements. The time limit for furnishing correction statements has been brought down from 6 years to only 2 years. So this is a very, very major policy change that has been brought. What it means is, from 1st of April 2026, once the Act come into force, for the financial years 2023, 24 and prior years, you cannot file any correction statements. So if the deductors have to file any correction statements for financial year 23, 24 and prior years, they have to do it by the end of March, that is by March 31st, 2026. So this is one major change that has been brought in the Act. And yes, it's be important, as you know, TDS TCS provisions, they kick in on the 1st of April 2026. And the relevant rules and the forms, they are in final stages. They'll be notified very soon. And so with this, I conclude. And I once again thank ICI for giving me this opportunity to be part of this session. And we look forward for this session. Thank you so much.
Thank you, sir. Thank you for highlighting the importance of new Income Tax Act 2025 and especially TDS and TCS on it. Today, we are talking about TDS and TCS, the two silent superheroes of the Income Tax Act 2025. You may not see them wearing caps, but trust me, they show up everywhere, whether it be salary, income, professional fees, or even you buy something. TDS is like that friend who takes a bite of your food before giving you the plate. Well, jokes aside, they are clever systems collecting tax before we even finish earning or spending. It keeps revenue flowing, keeps paperwork cleaner, and ensures no one disappears magically at filing time. So, yes, TDS and TCS don't wait for April panic season. To further explain this, we have today's speaker, CA Prerna Peshori ma'am. She is a chartered accountant and international tax lawyer heading the International Tax Division at Peshori Consultants. She advises clients across international taxation, transfer pricing, merger and acquisitions, cross-border structuring, litigation, and including startup global transactions. Recognized globally and tax cooperative Future Leader, IFA YN Research Award, International Research Award by ICI, and speaker at IFA Congress and APAC. Academic contributor teaching international tax law at ICI, ADIT UK, national law universities, and delivering professional lectures at various universities and colleges. She is an active researcher pursuing PhD in international taxation, publishing papers, and authoring books in the domain. With this, I welcome with a big round of applause CA Prerna Pashuri ma'am, our today's speaker, and hand over this session to you. Over to you,
Thank you
ma'am.
so much. Thank you so much, Ashish ji. Thank you so much to the Institute and the Direct Tax Committee for inviting me for this session. Thank you so much, Piyush sir, Vasanta sir, for sharing your valuable thoughts. So I would just, before proceeding, like to share my screen. I hope this is visible. Is the screen visible?
Yes.
Yes, ma'am. Yes, ma'am.
I think it's dropped.
Ma'am,
Yeah. Okay. It's visible, right?
yes, ma'am.
Okay, perfect. Yeah. So, before getting into the TDS, TCS, let me just really appreciate the way it has been structured from almost over 50 sections, what we used to have starting from 192 and going up till 206C, all of those sections pertaining to TCS. A very extensive exercise has been carried out and worth like appreciating that it's a very extensive exercise, not so easy to consolidate more than 55 sections into just 10 sections, wherein an ease has been presented in terms of understanding the sections in the tabular format from the earlier provisos and explanations. So that kind of structural change has been carried out. But having said that, the substantive provisions remain more or less the same. Of course, there would have been few changes. A major change also, which Vasanta sir also highlighted, that the correction statements can now be filed up to 2 years from the earlier 6 years. So yes, that has been a change, but beyond that, more or less the TDS thresholds, the TDS tax rates, all of that still remains the same. So even though a structural change has been presented in terms of how the sections used to look earlier and now they are more easy to understand in the form of the tabulated structure that has been created. All the sections from 192 till 195, 196 series which were there, they have been put all under section 392 and section 393 instead of having the separate section, and under that we have the tabulated mechanism. So this system is very well appreciated, in fact, and like it is more in terms of the ease that this is presenting. So earlier there was a scenario where the Income Tax Act itself, as was highlighted by Piyush sir also, as was highlighted by Vasanta sir also, that it became very bulky. So this particular act is representing a significant overhaul in terms of replacing the Income Tax Act with consolidation of every sort of section that was there through a fundamental restructuring, but at the same time maintaining the substantive provision as is. So the transition also remains very smooth, wherein the substantive provisions remain the same, thus the transition is not going to be that difficult. Of course, we need to still understand, but there is a good bridge which is created between the Income Tax Act 61 and the Income Tax Act 2025, which now is moving towards a compliance by convenience rather than compliance by creating some sort of confusion that was there in the 1961 Act. So there is this structural consolidation of the earlier TDS TCS chapter which was there, which was scattered around chapter 17B. having, so many sections, and new levies were introduced. So there were, always new sections putting up into that. Now there's a more cleaner, more logical architecture. Everything is consolidated. It is streamlined into one. And whenever the amendments will take place, it would be like a serial number to the table that would be happening. So with this note, I would just start with this particular topic of TDS and TCS, which is very, very important. And most of us would want to understand from the 1st April itself, because when the payments would be happening, when the transactions would be happening, invoicing would be happening, the first thing that we ask is whether the TDS and TCS is applicable, right? Because from the 1st April onwards, we would have the new Income Tax Act coming in, and the new TDS provisions would also come in. So this is going to be a very, very important chapter to understand from the income tax perspective, which will help us just streamlining our processes well before the April or the new tax year commences, now that we have, right? So I have just made a comparative over here, which shows that what were the section numbers earlier. It's not going to be a very easy task for us to just, delete all the sections that we have learned for our lifetime and remember the new sections. But it is going to be a simpler process, because now that we don't have to remember, like different sections, because everything, as I am saying, constantly has been put into one place. So section 392 pertains to the salary, which covers the erstwhile section 192 and 192A. This covers the salary and the PF withdrawals. Then for all other TDS, we have section 393. Section 393 has been bifurcated into 4 tables. So table 1 denotes the payment to the TDS on the payments to the resident payer. Table 2 denotes the TDS on the payment to the non-resident payer. Table 3 denotes the payment to any other person, so TDS on that. And table 4 denotes the exemptions with respect to TDS. So, unlike earlier, wherein for each and every section, we used to have, like, in front of us that, okay, let's say we are talking about section 194C, which was the TDS on the contract payments, wherein the TDS is not applicable on the carriage of the goods if the transporter has less than 10 vehicles. Now, this was mentioned in the section itself. Now, since the consolidation exercise has taken place, so this would be very well reflecting in table 1, which concerns the payment to a resident payer. However, the non-applicability of 194C would not be reflecting in table 1, but in table 4. So all the exemptions from the TDS have been put in one place in table 4. Then in terms of the interpretation of the terms, again, the interpretation of the terms have been defined in section 402 separately. So all the wordings, terms which are undefined have been defined in section 402. So when you read the Income Tax Act 2025 TDS provision, you have to read it holistically. You don't have to just stop at table 1 or table 2 to decide, okay, what is the threshold or what is the tax rate. You also need to refer to table 4 to see whether there is some exception or the exemptions which have been given. You also need to understand the terms which are defined in section 402. So all of that goes hand in hand. Then in terms of the lower deduction certificate, which we used to file 197, 195 too, they have been taken to 394. Then the TDS is also an income. Section 198 is in 395. All the compliances in terms of section 208 to 206AB, all those compliances in terms of TDS returns, TDS payments, and the TDS certificates which the payer had to give have been put all consolidated in section 397. So earlier, we had the same compliances put under the 2 buckets, for one for TDS, one for TCS. Now everything has been put in one bucket, which is under section 397. Again, this represents that there is a lot of consolidation exercise which had taken place, which is going to give a very convenient reading to the taxpayers, to the tax advisors, because the language has been tried to be very simplified. A cleaner look, a more logical look has been given to the act. Then in terms of the assessee in default for not paying the TDS or not deducting, not collecting, have been again put into section 398. Thereby, the similar provision was section 201 and 206C under the ITA 1961. Processing of TDS statements is under 399, which represents section 200A or 206CB of the earlier act. So this is the scheme of the TDS TCS provisions under the new act and a comparative that is being presented. Now, starting with the very first section, which is TDS on the salaries. This was erstwhile section 192. There has been not much of the change in terms of what section 192 was earlier and what we have under 392 now. So everything remains more or less same, but just as I said, a consolidation has been carried out. So here I've listed the section itself. It says any person responsible for paying any income chargeable under the head salary shall deduct the income tax on the amount payable, and the deduction shall be made at the average rate of income tax computed on the basis of rates in force for the tax year. So earlier we had this concept of the previous year and the assessment year, but now we have this tax year replacing that. So that has been just a change, but the deduction of the TDS on the salary at what point in time, at what rate remains the same. There's not been any change in respect of that. So any person responsible for paying any income will cover not only the resident payer, but it will also cover the non-resident employees as well, even now. So because the terminology is any person. So even when a non-resident employer is making a payment to a employee who can be resident, who can be non-resident, it can be a non-resident employee also if they are performing the services in India, so or rendering the services in India, then in terms of that, if there is a taxability here in India under section 912 of the erstwhile act I'm talking about, so in that particular case under section 192 also there was the TDS liability. Similarly under 392 also there is a tax liability on the person who is responsible to pay. It can be a non-resident employer or it can be a resident employer, and same goes for even the employee. And TDS shall be deducted at the average rate of income tax. How do we find the average rate of income tax? Is dependent on the slabs of that particular individual. So in that particular case, that shall be applied for conducting the average rate of tax, right? And it will be on the amount which is payable, and this shall be made at the time of the payment. The TDS shall be there. Then the second provision which has been there is talking about the person responsible for paying any income in the nature of a non-monetary perquisite, which is chargeable to tax under 17(1). Then the employer has the option to pay to tax on the whole or part of such income without making any deduction at the time when the tax was deductible at the average rate of tax. Again, this remains the same as section 192(1)(a), which also provided earlier the same way that any person, the employer who is responsible for paying the perquisite, which is non-monetary perquisite, which is covered under section 17, may at his option pay the tax on the perquisite, non-monetary perquisite, without making any deduction, right? And again, this had to be at the average rate of tax. So this is nothing but 192(1)(a) of the erstwhile act. So 192(1)(a) and 192(1)(b) are now consolidated in the form of section 392(2). Then we had earlier 192(1)(c), which used to provide for the deducting the tax by an eligible startup who is responsible for paying the perquisites in the form of the sweat equity, right? So in that particular case, the deduction would be, the time frame was given within 14 days after the expiry of the 48 months from the end of the relevant assessment year, or from the date of sale of the sweat equity, or from the date of assessee ceasing to be the employee, whichever was earlier. So the same thing has now been put into 392(3). So if you see the way sections are put up now, earlier it was 1(a), 1(b) like that. Now it's much cleaner, which represents like 1, 2, 3. There are no like wordings given besides the section number, and it's very easy to understand also. So now what they have done is they are saying the same thing over here, that any person who is an eligible startup referred to in 140 which was erstwhile ATISE, responsible for paying the sweat equity, which is a perquisite specified under 17(1)(d), shall deduct or pay the tax on that income on the rate basis of rates in force for the tax year in which the specified security or sweat equity is allotted or transferred within the time specified in 289(3). So the time has now been specified in a separate section itself, unlike the earlier 1C which was there. And then the other provisions of section 392 more or less remains the same, which talks about that the employer, before making the payment, shall take into account the details from the assessee. Basically, they would introduce these rules which will provide that the forms, like even today when the employees have to furnish the declaration to the employer regarding their any other income, regarding their salary income from any other employer, regarding any relief which they want to claim, regarding any loss under the head income from house property. So basically TDS, TCS under any other head which is there. So all of that they will have to submit as a declaration, so which remains the same even under the section 392, which was earlier there under the earlier Income Tax Act. So that simply remains the same. So there is no change per se in terms of the section 392 which is there and section 192 which was there earlier for the salary. The provisions have been more or less remaining the same. And of course, the employer then will have to furnish the statement with respect to the perquisites, which they earlier used to give also basically in terms of whatever the deductions are happening. So that the certificate which is there, so all of that still remains the same. Then moving on to the next income tax section. Okay, before we move on to that, we also going to talk about the 192A, which was concerning the PF withdrawal earlier, which has now been consolidated in section 392 itself, right? So earlier we had two separate sections. One was 192, which was concerning the salary, and second was 192A, payment of accumulated balance due to an employee. So this has now been put again under section 392, as I highlighted earlier itself, that this has been put under the head under the section of 392 itself, wherein the trustees of the recognized provident fund or any other authorized person, before making the payment of the accumulated balances of the recognized provident fund, when they make the payment, they have to deduct the TDS. Same goes with the in respect of the approved superannuation fund also, and shall at the time of payment will deduct the TDS at the rate of 10% over the payment of more than 50,000. Again, this remains the same as section 192A of the erstwhile Act. The TDS rate, the thresholds have remained the same. Okay, now coming to this very, very important section, section 393, which is, as I said, bifurcated into four parts or four tables, as we may say. The first table concerns the payment to the residents. Second table concerns the payment to the non-residents. Third table concerns the payment to any other person. And fourth table talks about the non-applicability of TDS. So what I've tried to do over here is, I have tried to make it into three tables, and for your ease of understanding, the table 4, wherever the TDS has not been applicable, I've tried to link here in the respective table itself, so that it's much easier for you to understand wherever the TDS is not applicable. So we'll go one by one to see what have been the new provisions, how they have been put up, because as I said, the substantive provisions remain the same. The TDS rates, the TDS thresholds have not undergone any change. What has undergone change is the way the sections were worded earlier, and now they have been much simplified into the tabular format. So first we are talking about the section 393, 393(1), which is there, the table 1, which is there. It says, where any income or any sum is credited or distributed by the specified payer, which is there, during the tax year to a resident, then the person responsible for paying such income shall deduct the income tax either on the entire amount of the income tax, if the amount exceeds the specified threshold, at the rate which is specified in the table, at the time of credit or at the time of payment, whichever is earlier. So this is how the section 393(1) has been worded. And when we talk about the person responsible for paying, so it has been defined in section 402. So who is the person responsible for payment? For example, in terms of salary, it's the employer. If it's a company, if the employer is a company, then the principal officer also. So for all of this has been referred, who is the person responsible for paying? It has been defined under section 402. And therefore, it becomes very important to keep referring to 402 time and again to understand the definition of certain terms, as I was saying. Because if we just read this, we may not come to a correct conclusion, right? So 393 first talks about commission or brokerage. Now, first one is income by way of commission for soliciting or procuring insurance business. This was section 194D in the earlier Income Tax Act. The payer was any person. It still remains the same. The rate and the threshold is given rates in force and the threshold was 20,000. So this still remains the same. So nothing has changed in terms of that. Now, again, we had 194H, which is any other commission or brokerage other than the insurance commission. Right? Now, see, one was in 194D and the second one was in 194H. So now they have been put together into one place to give the ease about that all the commission and brokerage are covered at one single place. Right? So here the payer which is there is a specified person. Now who is a specified person? Again, specified person is not defined in 393 but is defined under section 402. So who is a specified person? The specified person means any person other than individual or HUF. And in respect of individual or HUF, the total sales, gross receipts or turnover from the business or profession exceed 1 crore in case of business or 50 lakh in the case of profession during the preceding tax year to the year in which the income is paid. So basically, if you remember, under the erstwhile 194H, we used to have the person who is required to deduct the TDS, and then for individual or HUF, we had this exclusion saying that individual or HUF is required to deduct only when these thresholds are crossed. But here they have just put it specified person and then they have defined what a specified person is. So this way they are able to reduce the length of the wordings without creating unnecessary confusion, so that there is no repetition of the same thing again and again, and therefore they have put it everything under section 402. The rate here remains as 2% TDS rate and the threshold is over 20,000. Again, when it is not applicable, it is in respect of commission or brokerage payable by BSNL or MTNL to the public call office franchisee. Now again, what is commission or brokerage? The commission or brokerage has been defined again under 402, which includes any payment received or receivable directly or indirectly by a person acting on behalf of another person for services rendered not being professional services or for any services in the course of buying or selling of goods or in relation to any transaction relating to any asset, valuable article or thing not being securities. So basically, everything which is there,
Excuse me,
there
ma'am.
is, yes,
Ma'am, your PPT is not visible as of now.
it's not visible. One second. Let me reshare. Oh, it has stopped sharing somehow. Is it visible?
Yes, ma'am. Now it's okay. Thank you.
Okay. Yeah, I'm so sorry. So The commission or brokerage, as I said, that has been defined in 402. And again, the definition remains the same. There is no change in respect of that. Then next one is second one, the rent. Now, rent, again, two types of rent were covered under the old Income Tax Act. One in section 194IB, which was introduced for person who are not having the turnover more than 1 crore or 50 lakh, if we remember that, right? And the second one was under 194I, right? Now, again, they are put into one place. So 194I is covering specified person, right? So here they have said that 194IB, earlier one which was there, first one is saying person other than specified person, meaning who is a specified person? As I said, individual HUF who doesn't have the turnover, a specified person who have the turnover more than rupees 1 crore or 50 lakh in case of profession. So in that particular case, the rate will be that of 194I itself, which is 2% for use of any machinery or plant or equipment, 10% for the land and building. And the threshold is 50,000 a month or part of month, again remains the same. Person other than specified person. So any other person or individual HUF which is not having this turnover thresholds crossed, that will be covered under the first category. The rate is 2%. Threshold is 50,000 for a month or part of the month. However, tax shall be deducted at the time of credit or payment, whichever is earlier, for the last month of the tax year or the last month of tenancy. And in case there is non-furnishing of pan, then higher rate is applicable. However, that shall not exceed the rent of the last month. Again, this is not provided in section 393. This has been separately provided in 398. What is the definition of rent? Again, that is not provided in 393 but in 402, which means the same as it was in the earlier act of 194I itself, which says it means any payment under any lease, sublease, tenancy or any other agreement or arrangement for the use of any land, building, factory buildings, land pertinent to buildings, machinery, plant, equipment, furniture, fittings. So that's about the rent. Third one is the payment on transfer of certain immovable property other than the agricultural land. Now, again, it has combined every kind of transaction in respect of immovable property at one place in one particular section. So, this is all part of the tabular presentation which has been made. First is regarding any consideration for the transfer of immovable property, which refers to the erstwhile 194IA section. Here the payer is person other than the specified person. Now why they have said person other than the specified person? Because this is individual or HUF which is covered over here, which is basically making the payment for the purchase of the immovable property. So in that particular case, there is the TDS, which is 1% of the higher of the sale consideration or the stamp duty value, whichever is higher, right? So here again, they have made this reference in terms of the footnotes, which is basically talking about the consideration will include all sort of consideration payable by all the transferees to all the transferors. So basically this threshold limit which is there of 50 lakh rupees, the threshold limit which has been there for 50 lakh rupees. So in that particular case, the threshold limit is to be applied qua all the transferors and qua all the transferee. This has not to be broken up for each transferor and each transferee. Okay, and in terms of the transfer of the immovable property, so whatever shall be higher. So whether the sale consideration or the stamp duty value, whatever is higher more than 50 lakh will be taken into consideration. And then in terms of the cash consideration for the joint development agreement, so which was earlier section 194 IC, covers any person, rate is 10%. Then any compensation or enhanced compensation paid for the compulsory acquisition of the for the compulsory acquisition of any immobile property other than the agricultural land, which was covered under 194 LA. So the threshold is 5 lakh and the rate is 10%. Now, what is the consideration for the transfer of immobile property? Again, that has been defined in 402, which shall include all charges of the nature of club membership fee, car parking fee, electricity, maintenance, advance fee, which are incidental to the transfer of immobile property. Next, we have the income from the capital markets, again covered at one place. Dividend is not covered into section 4, but I put it here again to put it everything together, income from the capital market. So income in respect of units of mutual fund, which was section 194K earlier. Payer is any person. The rate is 10%. The threshold is 10,000. Then the income distributed by a business trust to a unit holder. In case the unit holder is a resident, then the payer will be the business trust. It can be REIT, InvIT. Under section 194 LBA, it used to be covered in the erstwhile act. The rate is going to be 10%. What are the exclusion are given in the table 4. So the exclusion is if the special purpose vehicle has not exercised the option under 200. Now what is this? So basically, if we remember in the erstwhile act with respect to the taxability of the unit holders in respect of any dividends. So where the special purpose vehicle used to exercise the option of the concessional tax rate of 22% under 115BA, then the dividends would have been taxable in the hands of the unit holder. However, if the special purpose vehicle has opted out of the concessional tax regime, it has not opted in for the concessional tax regime under 115BAA, then the dividends would not be taxable even in the hands of unit holder. So now that 115BA concessional tax regime has been now put under section 200 of the new act, and that's what the same scheme remains over here. So if the special purpose vehicle has not exercised the concessional tax regime under 200, then in that particular case, the dividends will be taxable in the hands of the unit holder, in which case the business trust will have to deduct the TDS at the rate of 10%. Any distributed income payable to a unit holder of a AIF, while it was covered under 194 LBB, AIF is liable to deduct the TDS at the rate of 10%. In case of the investment in securitization trust, any income will be liable to TDS at the rate of 10% by the securitization trust. This was covered under 194 LBC. Now, dividend covered under 194 of earlier act. Any domestic company which is making the distribution, declaration or payment of dividend has to deduct the TDS at the rate of 10%. The TDS is not applicable. So under table 4, they have listed this dividend paid to the LIC, General Insurance Corporation, to a business trust by SPV. If a business trust pays to the unit holder in the nature of dividend, distributed income which is in the nature of dividend, then the business trust has to deduct the TDS. If the SPV has not exercised the concessional tax regime under 200, then in that particular case, the business trust also need not deduct the TDS. But when a SPV pays the dividend to the business trust, in that case, the TDS is not applicable because that is not a taxable transaction at the first place. And in case of an individual shareholder, if the dividend is paid not in cash and the dividend is less than 10,000 rupees, then in that particular case, the TDS is not applicable. So there's this threshold, but this is only in respect of individual and therefore it's given in table 4, okay, and not in table 1. Then interest income we are talking about. So in respect of the interest income, interest on securities. This was covered under section 193 of the earlier act. The payer can be any person. the rate of the TDS will be as per rates in force. The threshold will be rupees 10,000. Again, this remains the same. When the TDS is not applicable on interest on securities, if the the interest is in respect of the bonds which are there are specified list of bonds which are covered. So in those cases, the TDS will not be applicable. So again, that list of the bonds which are there in the erstwhile act and what we have now has more or less been same, except there have been few changes, maybe because those bonds are no more prevalent, because those were very old bonds which are there. So maybe that has been removed, but interest on, for example, national development bonds, the debentures issued by the central government, right, or any securities of the central government or state government, interest payable to the life insurance corporation, interest to the general insurance corporation or any other insurer, or interest payable by the special purpose vehicle to a business trust. In those cases, the TDS is not applicable. Then interest on other than securities, any other interest, which was earlier covered under 194A. Again, they have bifurcated into two rows. One, which is where the payer is a bank, a cooperative bank, or a post office. The rate is rates in force. The threshold is 1 lakh for a senior citizen and 50,000 for others. Again, this remains the same, right? Any other interest, which is where the payer is again a specified person, which means individual or HUF, whose turnover is more than 1 crore in case of business or 50 lakh in case of profession. Now, what are the exclusions? Interest paid to banks, LIC, financial corporation, insurance companies, unit trust of India, a company carrying out the insurance business, any interest paid or credited by a cooperative society to its members, by one cooperative society to another cooperative society, in respect of deposits with a primary agricultural credit society or a primary credit society, in respect of deposits with a cooperative society which are they engaged in the business of banking. So basically that other than time deposits, saving bank deposits sort of interest. Exception is there again in that respect, which was earlier also there in the 194A, which provided that where the turnover of the cooperative society exceeds rupees 50 crore rupees during the preceding tax year, and the interest which is paid is more than this threshold of 50,000 or 1 lakh in case of senior citizen. In that particular case, this exclusion will not apply. Interest on the saving deposits which are there, saving bank deposits with the bank, interest on the compensation by the motor accident tribunal, interest payable by an infrastructure capital fund or the infrastructure debt funds or on the zero coupon bond, interest by a partner of the by a firm to the partner, all these are not liable to the TDS. But this has been covered as a part of table 4 and this is not present in table 1. So that's why you have to not just look into table 1, but you have to also read it alongside table 4. Because if you see, for example, we are talking about this dividend. If you look at the first glance, you may miss out that the TDS is only 10% without any threshold. But if you look at table 4, you would get the information that the threshold for the individual or HUF, for the individual is 10,000. If it is below 10,000, the TDS is not applicable. So therefore, the holistic reading is very, very important when you are reading the TDS provisions. Right? Then payment to the contractors, fees for professional and technical services. Again, all is put at one place. So earlier, we used to have this lot of confusion about 194C, 194J, Then we had 194M, which was newly introduced. All was scattered here and there. Here they have put it everything at one place under one bucket. Again, this represents that there is so much of structural ease that they have tried to create it in terms of the characterization under the Act, the presentation under the Act. So that it's all at one place basically. They have tried to put it all the similar transactions, they've tried to club all the similar transactions at one place. So when you see specifically for resident, they have bifurcated into this 7 different buckets or 8 different buckets. So here, when we talk about the 6th pointer in the table, we are talking about payment to contractor fees for professional and technical services. So the first one in that is any sum for carrying out any work, including the supply of labor for carrying out any work in pursuance of a contract between a contractor and a designated person. Now, contract is again defined in section 402, which includes the subcontractors. The definition of the work has remained the same as it was earlier. There has been no change. So if you look at the provisions, again, I'm emphasizing, you don't have to be really scared to say that there has been a substantive change which has taken place. Some new thresholds are there. Some new definitions have been introduced. It's not really like that. A very simplification, a structural exercise has been done in the Income Tax Act 2025 to make it much simpler, because the TDS was very, very voluminous chapter of the Income Tax Act of 1961, which has been put into these 8-9 sections in the new Income Tax Act. So this represents section 194C of the earlier Income Tax Act. The rate remains the same, 1% if the contractor is individual or HUF, 2% if it's other person. Thresholds remain the same, 30,000 for any sum, 1 lakh in case of aggregate of such sum. Now, what is the definition of a designated person? Again, the designated person has been defined in section 402 itself. So, again, when we refer to the 402, it says designated person means the government, central, state, local authorities, corporations, company, cooperative societies, any authority constituted in India for the housing accommodation, societies which are there, trusts which are there, universities which are there, partnership firms which are there, or any individual or HUF if their sales exceed 1 CR in case of business, 50 lakh in case of the profession. So here the payer is any designated person, which was also there in the erstwhile Act. And one of the exclusions, again, they are given in table 4, where any sum is paid to the account of the contractor during the course of business of plying, hiring or leasing goods carriages, and they own less than or equal to 10 goods carriages at any time during the tax year. They also furnish their PAN and a declaration to that effect, or where the sum is credited by the individual or HUF for their personal purposes. Then this particular section is not applicable. Second one is any sum for carrying out any work, including the supply of labor for carrying out any work in pursuance of a contract or by way of professional services or by way of commission, not being an insurance commission or brokerage, or which is not covered in the first point that we had covered. So this is, I think yes, typo error, but this is section 194M, which is there. So this is section 194M of the erstwhile Act. So just change it over here, I think. Yeah. This is section 194M of the erstwhile Act, wherein the individual or HUF, which is not a specified person, is required to deduct the TDS when the threshold of 50 lakh is met and the rate here is 2%. And third one is any sum by way of fees for professional services, fees for technical services, director's remuneration, royalty, non-compete fee. It is comparable to 194J of the earlier Act. Here, the payer is a specified person, individual HUF, whose their total turnover is more than 1 CR in case of business and 50 lakh for profession. That I think, 1 second, there's some mistake over here. The rate here which is given is rate of the earlier act only. Here there is no change in terms of the rate. The rate is still here 10% and 2% which was there. So again, here's the typo error. We'll change the presentation here. So what is the rate which was given over there in 194J? The rate still remains the same, which is 10% in all other cases and 2% in the case of fees for technical services, royalty in the nature of consideration, which is for the sale, distribution or exhibition of the cinematographic film, pay who was engaged in the operation of the call center. So in those cases, the TDS rate is 2%. In all other cases, it is going to be 10%. So that still remains the same. So there's been no change in terms of that. So basically, the TDS rates for 194J is still the same. In terms of the fees for technical services, it is 2%. Other than the, of course, professional services, the royalties which is there in the consideration for the cinematographic film and for the call center operation. For every other, it is 2%. Now, what is the fees for technical services? Again, that is defined in the section 402. What is professional service? What is fees for technical service? All of that has been defined in section 402 of the Income Tax Act. So, fees for technical services shall have the meaning as it is section 97B, which is comparable to section 917 of the old Income Tax Act. Royalties again has been defined in section 402, which again refer back to section 9. So again that remains the same. Then in terms of the professional services means services rendered by a person in the course of carrying on legal, medical, engineering, architectural, professional services or profession of the accountancy or technical consultancy, interior decoration or advertising, or professions which may be notified. So again, that definition more or less remains the same. I think the screen sharing stopped. 1 second. Just a minute.
Yes, ma'am, the PPT is
Yeah,
paused.
because it hanged, I think. 1 second. It just shut down. One second. Is it visible now?
No, ma'am, not visible.
Okay, then. Is it visible now? Has it not been shared?
Not yet,
No,
ma'am.
Prerna.
No? 1 minute.
No, not.
Now? Yeah, I think so. Now it is visible.
There is a message that you have started your screen sharing.
Ah,
Yes, yes.
yeah, it's visible.
Yeah.
Now
Okay,
it's
okay.
visible.
Yes.
Yeah. Okay. So that's what I was saying regarding, so sorry, regarding this, some technical glitch. So basically for the fees for professional services, again, it's more or less same, of course, there is some kind of linkage that has little been changed in terms of how it was linked earlier to the section 44AA with respect to maintenance of books of accounts versus now how it is. But more or less the substantive understanding of the act remains the same. So that is with respect to the fees for technical services. Then in respect of the uh, royalties, again, royalties, as I said, is defined under the section 9 itself, wherein they have defined with respect to reference to section 9, the understanding will remain same as it was earlier. So that is like, similar provision as 194J. Now, again, in terms of the threshold which is there. So if you remember, the threshold in the earlier act was not applicable in respect of the director's remuneration. So the threshold of 30,000 which used to be there, that threshold was separately there for every other item which is listed, isn't it? So that now is no more there. So that now is similarly there. So basically the threshold which is there of 30,000 is similarly there for all the other items except for the director's remuneration. So that still remains the same. So there has not been any substantive change in terms of what has been there under the earlier law and what is there under the new law. Only thing is that they have tried to put it everything at one single place instead of like the earlier sections which was spread across the multiple section numbers. So that has been done away. So if you see the majority of the sections that we have covered so far, the substantive changes have not taken place. It's only the way the sections have been structured that has undergone change, which will require our good amount of understanding. Just to get the clarity with respect to, as I said, that how we need to read the table 4 along with table 1 or the definitions in 402 along with each and every section. Because earlier, if you see, 194J had this definition of the professional services. But now they have been separately provided in section 402. So fees for professional services, fees for technical services, remuneration, royalty, and the non-compete fee, which is there. So the thresholds out of that for the fees for professional services, for technical services, for the royalty and the non-compete fee is 50,000. And for the director remuneration, it will be nil. So that is going to be there. Okay. And in terms of the rates also remain the same. Fine. Now coming towards the other important point in respect of this is in terms of the contract, in terms of the works contract. In the erstwhile section also there was this provision, if the invoice value is separately giving the value of the materials and the value of the services, then on the material value we will not have the TDS. But if the material value is not separately specified, then we would have TDS on the same, and that has been incorporated here by way of the note. Okay. Now moving towards the next section, which is concerning the payment to the residents in the other category. Any sum under a life insurance policy, including the sum allocated as a bonus on such policy, which was earlier 194DA. Again, your payer is any person. 2% on the income comprised in such sum, on that TDS will be there. Threshold is 1 lakh. Then on the purchase of goods, where the sum exceeds rupees 50 lakh. It was earlier in the 194Q. The payer here will be the buyer. The rate will be 0.1%. And what is again the meaning of the buyer? A buyer is a person whose total sales turnover gross receipts is more than 10 crore in the preceding tax year, in the preceding tax year. Now, what is the threshold year? 50 lakh rupees. So, here the tax shall be deducted on the sum exceeding 50 lakh. So, that is my threshold over here. Then, in terms of the total income of a specified senior citizen after the deduction under Chapter 8 now, and the rebate under 156, earlier it was under 194P. The payer will be your specified bank. Rate will be rates in force. Threshold will be the slabs which will be applicable. Now, who is a specified senior citizen? Again, that has been defined in section 402. Specified senior citizen means an individual being a resident in India who is of more than 75 years, having the pension income and no other income except the interest received or receivable in the same bank in which he is receiving the pension, and he has furnished a declaration. Then next one is the sum on account of sale of goods or services by an e-commerce participant, which is facilitated by an e-commerce operator through its digital or electronic facility or platform, the erstwhile 194O. So in this case, the rate will be 0.1% of the gross amount of sale or services or both. Payer will be any e-commerce operator, and the threshold here is nil. Now, what are the exclusions here where the amount is credited or paid to the account of an e-commerce participant, which is an individual or HUF? The gross amount of the sales or services are less than 5 lakh, and the e-commerce participant has furnished the PAN and Aadhaar to the e-commerce operator. Now, again, what are the definitions of e-commerce, e-commerce operator, e-commerce participant have been given under section 402. So e-commerce means the supply of goods or services or both, including the digital product over the digital or electronic network. E-commerce operator means a person who owns, operates, manages the digital or electronic facility or platform. E-commerce participant means a person who is resident in India selling the goods or providing the services or both, including the digital products to digital or electronic facility or platform for electronic commerce. So all of this again remains the same in terms of section 194O, how it was there. Further, any payment which is made directly by the customer to the e-commerce participant for the goods or services facilitated through the platform of the e-commerce operator shall be included in the gross amount. This provision was earlier also there, and it has now been also there. And from the gross amount, you will exclude the amount received for hosting advertisements or providing any other services. Then, in terms of any benefit or perquisite, whether convertible into money or not, arising from the business or exercise of a profession of any resident, it was earlier section 194R. Here, the payer would be the specified person. The rate shall be 10%, which is going to be the same. The threshold limit is 20,000, 10% of the value of the benefit. And the last one is the sum by way of consideration for the transfer of virtual digital asset. This was covered under section 194S of the erstwhile Act. Here the payer would be any person. The TDS will be at the rate of 1%. There is no threshold. In the exclusions, it is mentioned that where the value or the aggregate value of such consideration does not exceed 50,000 when payable by an individual or HUF whose total sale is less than 1 crore or 50 lakh and not having income under the head profits and gains of business or profession, or 10,000 when payable by any other person other than referred to in it. So that is the kind of comparison that I've tried to draw in terms of the sections which are there, which are covering the resident. Now, in terms of what is virtual digital asset, again that has been defined in the, not in section 402, but in that particular section which is concerning the definition, because it was not even earlier there defined over here. So they have made the reference over there. What is a virtual digital asset? So all of this, if you look at it, this is in a way a very simplified exercise which has been carried out. So all those sections which used to be applicable under the erstwhile Act 193, 194, all those series of 194C, J, all those have been bifurcated into different buckets and put under table 1. And based on that, now it's very simplified exercise that has been carried out, that in terms of readability, in terms of structuring, it's very simpler to understand and compare which kind of provision will be applicable to which kind of payment. Right? So instead of juggling through multiple sections, there is a very easy reading that has been tried to be created by way of this particular exercise. Then the table 2, which is there, it is concerning the payment to the non-residents. So earlier also the payment to the non-residents on which the TDS were applicable was not just covered under 195. It was under 194E, 194LB, LBA, LC, LD, all those sections, right? Now also we have those things put in place, but under one particular table itself, right? So in this particular case, if you have a look at it, the payment to the non-residents which are there are put as the way we have it for residents. I think, one second. Yeah. So the way we have it for residents, we had it, all the provisions put into place for resident. Similarly, we have
Ma'am,
created
it's still not
everything.
visible.
It's not visible. No, why is a problem happening? Now,
The message is showing that you have started. Yes, it's visible now.
okay. Yeah. So basically, in terms of the payments to the non-residents, some buckets are not created over here now. But because there are not like for non-residents, we don't have like dividend payment, then contract fees, fees for technical services. We don't have like that. So here we have very simplified tables which are covering all the sections which were earlier there for non-residents put into table 2. So that has been done with respect to the payment to non-residents. So let's have a look at it. So first is in terms of any income referred to in section 211. Now, what was this income referred to in section 211? This is basically in respect of the income of the sports person, entertainer from the activities. If you remember, there was this similar section which was there in the erstwhile Income Tax Act section 194E, which used to be there. So here they have put it under table 2, the same particular section, but here they are referring to the income under 211, which covers the total income of the sportsman who is not a citizen of India and a non-resident, from the participation in India in any game, from the advertisement, from contribution of articles in any journal or newspaper for the sports, income of the non-resident sports associations, entertainer for the performance in India who's a non-resident. So that has been covered under section this under this particular table 2. Now, who is required to deduct the TDS? The payee is going to be any person. The payer is going to be a non-resident sportsman who is there, or entertainer who is not a citizen of India, or a non-resident sports association. The rate of TDS is going to be 20%. Here, we do not have any threshold. We didn't have even under the erstwhile Act. So here also, we do not have any particular threshold being there. So that still remains the same. Okay. Next is any income by way of interest payable in respect of, money borrowed from a source outside India by way of issue of any long-term bond, rupee denominated bond, which is listed only on a recognized stock exchange located in IFSC. This was earlier 194 LC. The payee is non-resident or foreign company. Payer in the Indian company or the business trust. Rate is 9% where such bonds are issued on or after 1st July 2023. Again, this is simply what we had under 194 LC earlier. The same thing remaining over here. In fact, in terms of the other interest also, in terms of any loan agreement which existed between 2012 and 2023, or the bonds between 2014 and 23, that have also been incorporated over here. And similarly, any interest which is on the rupee denominated bond before 1st July 23, that has also been incorporated in table 2. Right? Then any other interest which is there, which was covered under 194 LB for the infra debt fund payer, that rate is 5%. Then interest income, distributed income in the nature of interest by a business trust, which was covered under 194 LBA of the earlier act, where the payee is the unit holder who is a non-resident or a foreign company. The payer is a business trust. The rate will be 5%. In terms of the dividend income, the distributed income in the nature of dividend income distributed by a business trust, which was earlier covered under 194 LBA, where the unit holder is a non-resident or foreign company. The payer is a business trust. The rate is 10%. However, this will not be applicable. The TDS will not be applicable when the SPV has not exercised the option under 200. So if you recollect, in the erstwhile act also, as I was saying, in the payment to resident also, the same thing is there, that the TDS will not be applicable on the distributed income in the nature of dividend if the special purpose vehicle is not opting for the concessional tax regime. So that remains the same both for resident and for the non-resident. Then distributed income in the nature of rent by a business trust to unit holder who is a non-resident or foreign company, the rate will be at the rates in force. Then income from AIF to the non-resident unit holder, it will be again at rates in force. Income from securitization trust to the non-resident unit holder, it will be again at rates in force. Income from mutual funds to a non-resident or foreign company, which was earlier covered under 196A, where the payer is any person, the TDS rate will be 20% or the rate under the DTA, whichever is lower, provided the payee furnishes the tax residency certificate and the form 10F, it was called earlier. We do not know now how they are notifying it. But if they provide these declarations, the 20% or the rate lower in the DTA will be applicable. Then we have LTCG from the transfer of units by the offshore funds or any income from the units. Payer can be any person. The rate will be 10% on the LTCG and 12.5% on any other income. Then interest or dividends in respect of American deposit receipts, global depository receipts, which was covered under 196C, it will be 10%. Long-term capital gain arising from the transfer, it will be 12.5%. Income in respect of securities by a foreign institutional investors. The TDS will be at the rate of 20% or the rate under the DTA, but it will not be applicable on the long-term capital gain. Income in respect of securities by the specified fund, it will be 10%. So everything is consolidated at one single place. The last residuary section that was the most important for us when we made the payment to the non-resident was section 195 in the earlier act. Now we have that in this particular table itself, which says any interest which is other than the interest covered above or any other sum chargeable under the provisions of this act, not being income chargeable under the head salary, where the payee is a non-resident or a foreign company. Payer can be any person, meaning if it's a resident or a non-resident, it will still be covered as a payer. The rate is rates in force. And here they are explicitly mentioned in the note that the obligation to deduct tax at source will be extended to all the person resident or non-resident, whether or not the non-resident has a residence or place of business or business connection in India or any other presence in any manner whatsoever in India. So which means what? That a non-resident is still required to deduct the TDS when he is making the payment to another non-resident, irrespective of the fact that he has a residence, place of business or business connection in India. Now, under the earlier 195 earlier appeared to be a consolidated self-contained provision in a way. Now it has been little more bifurcated because everything is put into one place. So the 195 has been broken up into different parts. For example, the 195.2 earlier used to provide for the application for lower deduction certificate by the payer, and 195.3 provided for the lower deduction certificate by the pay. Now all that has been put into one single place in the section 395, which talks about the lower deduction certificates. Then 195.6 earlier used to require to furnish the information in Form 15CA and 15CB. That has now been taken into section 397, which talks about the compliances. The grossing up of tax, which was covered under 195A, has been taken to section 393.10. So that's how section 195 has been bifurcated into different segments for again the structuring the entire TDS TCS chapter into different into one place basically. Then the third table concerns the payment to any person, which covers both the resident and non-resident. So any income by way of winnings other than from the online games, from any lottery, crossword puzzle, card game, gambling or betting, which was earlier covered under 194B. Payer can be any person. It will be at rates in force, and the threshold limit is 10,000 in case of single transaction. So this is again remaining the same as we had it earlier. Then in terms of any income by way of winning from the online games, which was covered under 194BA, it will be again any person payer at the rates in force, and the tax shall be deducted on the net winnings in the user account, or where there is any withdrawal from the user account, the tax shall be deducted at the time of the withdrawal on the net winning comprised in such withdrawal, as well as on the remaining amount of net winning at the end of the tax year. Again, this remains the same as we had it under earlier section. Then income by way of winning from any horse race covered under 194BB earlier. Here the payer would be the basically bookmaker or the licensor for this horse racing, and the rates in force will be the TDS rate, and the threshold is 10,000 in case of single transaction. Then any income for the stocking, distributing, purchasing, selling lottery tickets by any person, the rate will be 2% and the threshold is 20,000. Any amount referred to in 80CCA of the erstwhile act, they have made a reference to the 80CCA of the erstwhile act, the TDS rate will be 10% and the threshold is 2,500. Then we have the earlier 194N, withdrawals in cash, right? Wherein the payer is a bank, cooperative bank or a post office. The threshold limit will be for the recipient, which is a cooperative society, 3 crores. For other than cooperative society, it will be 1 crore. So the rate will be 2%. Then any sum in the nature of salary, remuneration, interest, commission, bonus to a partner, which was covered under 194T earlier by a firm, payable by the firm, the rate will be 10% and the threshold is 20,000. So again, that still remains the same. So these are broadly all the sections that have been put into place. Now, if you look at earlier, the Income Tax Act 1961, how we had to read it, each and every wording of the Income Tax Act 194C, 194J, the provisos, the explanations, which little bit caused a confusion. But now when you see together, it is a very comprehensive yet structured and much simplified as compared to the erstwhile act. So this is a much cleaner look to the erstwhile act, whereby consolidating everything at one place, they have tried to maintain the substantive provisions. And yet the thresholds have not changed, the rates have been kept same, the definitions have been kept same. So that there is an easy transition which takes place this year. Now moving towards the TCS, which was earlier under 206C. Now again, it has been put into one simple table under section 394. which talks about the different TCS on the sale of liquor, tend to leaves, timber, scrap, sale consideration on the motor vehicle exceeding 10 lakh rupees, which is still remaining 1%. Then remittance under LRS. This also remains the same, more than 10 lakh. For the education or medical treatment, more than 10 lakh, it will be 5%. And if the education is being done out of a loan obtained from any financial institution, then there is no TCS. For other than education or medical treatment, it will be 20%. More than 10 lakhs. In case of the overseas tour program package, it will be 5% up to 10 lakh, 20% more than 10 lakh. Again, this remains the same. There has not been any change carried out in the aspect of the TCS also. So all the TDS provisions have been put under section 393. The TCS has been put under 394. And when you read 393, if you have a look at that, you would see for every kind of payment, wherever they want to explain something, they have given the notes to that. So it's very important to read tables along with table 4 and the notes and the section 402. Plus, at the end of that, they have also said in 393 that the tax shall not be deducted on the amounts payable to any government, RBI, any mutual funds, so which was also there in the erstwhile Income Tax Act. And in case a person furnishes the declaration that the tax on this person shall be nil, basically a nil deduction certificate is furnished. For example, in the case of the withdrawal of the PF, insurance commission, rent, or interest, or in respect of life insurance policy or dividend. Right? So in these cases, if that is furnished, then in that particular case, the TDS will not be deducted. So all those procedural things have also been incorporated duly in 393 itself. And as I said, the crossing up provision has also been put into place. Then what the procedural sections apart from that are there under the 390 series which is there. So 395, section 395 talks about the certificates. So 395 says that where the tax is required to be deducted on any income or any sum under this particular chapter, then the payee can make an application before the assessing officer, which is equivalent to section 197, right, of the erstwhile act, for either lower or nil deduction certificate. And the AO on the examination, on being satisfied that the total income justifies the deduction at the lower rate or no deduction, may issue a certificate. And this certificate will be then given to the payer or the person responsible for paying for no deduction or lower deduction. Similarly, the payer who is paying to a non-resident, right, could make an application under 195(2) earlier to the AO. That has also been put under 395(2) itself, as I was telling you while we were referring 195. To determine what is the appropriate portion of sum chargeable to tax, because in many cases they are not able to identify what is the sum chargeable to tax. For example, in the case of capital gain. So the payer can make the reference to the AO to determine the appropriate portion of the sum which is chargeable to tax. So that has been also put under 395. So instead of earlier having 197, 195(2), 195(3), everything has now been contained in 395 for the lower deduction certificate. Even for the TCS as well, where the buyer feels that there is a lower TCS should be applicable. That has also been taken into 395(3). So that the buyer can also make the application under 395 itself. So everything in relation to the lower deduction certificate is contained in 395. Then 396 talks about that the tax deducted which is there has to be considered in the income. So the TDS which is there has to be taken as an income. It will be deemed to be the income received. Right? So whatever income tax that is deducted either in India or even outside India, that will be considered as the income of the assessee. So in that particular case, the TDS will be considered as the income of the assessee itself. Except, of course, in the case of the cash withdrawals. Right? That is not the income. Then 397 which is there. That talks about the compliances which are applicable. So again, all the compliances which were earlier there for the TDS and TCS, which was catered into different sections. Right? If you recollect in the erstwhile Income Tax Act, we had the compliances catered under multiple sections. For example, 200 spoke about the duty of person deducting the tax. Then 203 talked about certificate for tax deducted. 203A for the TAN deduction and collection account number. Then 203AA was for furnishing of statement of tax deducted. And similarly, we had this requirement again under 206CA for tax collection account number, 206CB, 206CC, all those sections. Isn't it? So that has now been put into one single place as the compliances. That is simply put into one single place for both TDS as well as for TCS. So what does it say now? The compliances which are there. First of all, section 397 says that every person who is deducting or collecting the tax should apply for the TAN number, tax deduction and collection account number. Right? And where the tax deduction collection has been allotted to them, they have to quote that. So this is very similar to what we had under section 203A of the erstwhile Act. That we have to furnish in all challans, in all certificates, without which of course we cannot file also. So the same thing has been incorporated over here, but it has been much simplified. So earlier it was written in such a bulky way that these sections were just stretched, but now it has been much simplified under 397. And the provisions of the TAN will not be applicable in case of certain assessees. For example, where the non-specified person is making the payment of rent, right? So in that case, the TAN is not applicable. When an individual makes the payment for the purchase of immobile property, again in that particular case, the TAN requirement doesn't exist. Or in case of the commission, professional fees, or the contractual payment, right, where a non-specified person makes the payment. So in that particular case, again, the TAN requirement doesn't exist. So again, that has been incorporated in 397 itself. Then, in case of the non-furnishing of the PAN, then in that particular case, there is a higher rate which is applicable. This was under section 206C. Right? So that was again saying that a higher rate will be applicable in case the PAN is not furnished. Right? So 206CC provided that if the PAN is not furnished, then in case of TCS, it will be at a higher rate. Same was in case of 206AA for the TDS. So that has been now put under section 397 itself, that every person who is paying has to furnish the PAN, or even in case of TCS, every person has to furnish PAN. In case of failure to do that, the tax will be at the higher rate under Act, rates in force, or 20%, 5% in case of purchase of goods or e-commerce operator. Similarly, for TCS, it will be twice the rate specified in the Act or at the rate of 5%. So again, that same thing has been retained over here. Instead of putting it into some different section like we had it under 206AA, that has been simply taken care under this section. Now, if you remember 206AB, a special provision for deduction for non-filers, higher rate for non-filers was omitted by the Finance Act 2025, and that is still not reflecting over here as well. So that still remains the same. In case of the 206AA, which was a separate section altogether, which provided that in these particular cases, the higher rate will be applicable, that is now taken under this particular 397. And in case of a non-resident, if he receives the interest on the long-term bonds, this particular higher rate will not be applicable. And in certain specified cases, for example, we had Rule 37 BC, which may be notified here as well. In those cases, the higher rate will not be applicable. But as of now, we do not have that here. And same goes in the case of TCS also. The higher rate of TCS will not apply in respect of no PAN if the non-resident does not have a P. Right? So then requirement to furnish the TDS TCS statements, again, that was a separate section 206A. That has been again put under 397, but that will be separately, the statements will be notified by way of rules and the notifications.
मैम आपके पीपीटी फिर से पॉज हो गए हैं.
पॉज हो गया क्या?
पीपीटी भी
अभी आ रहा
अब
है?
आए. हाँ जी, हाँ
Okay,
जी.
हाँ. Then again, in terms of the correction statement, this is a very, very important amendment, which is worth noting. In the erstwhile Act, we could furnish the statement, right? So any statement can be furnished, and at the same time, if there is some correction which needs to be done for rectification of any mistake, to update the information, right? We could do that for a period of 6 years. Now that is restricted to 2 years, right? So earlier, the correction statements and all could be filed for up to 6 years. But now that has been restricted to 2 years. So section 200 of the erstwhile Act provided that the correction statement can be delivered after the up to the expiry of 6 years from the end of the financial year. But section 397, this is the only major amendment which has been carried out, is restricting it up to 2 years itself. So whenever any correction statement will be filed, that has to be taken care. Now all the prior years, the timeline of 31st March 2026 will be there, after which you may not be able to rectify it. So from now onwards, it will be 2 years from the end of the tax year in which the statement is delivered. So that is about section 397. Then we have section 398, which talks about the consequences of failure to deduct or collect or pay, which was same as section 201, right? The person will be treated as assessee in default. The person will not be treated as assessee in default if the payee or the buyer, in case of TCS, furnish the ITR return of income, takes into account his income in the income tax return, pays the tax on the declared income, furnishes a CA certificate. In that particular case, the person will not be treated as the assessee in default. So if a person who was required to deduct or collect the tax does not deduct, does not pay, does not collect, or after deducting or collecting fails to pay, he is to be treated as assessee in default. But the exceptions were there earlier in proviso to 2011A, now has been there under 398 itself. Here we are not having any sort of provisos here. We have just the section numbers. However, in that case also, even when the assessee will not be treated as assessee in default, but the interest would still be payable at the rate of 1% per month from the date on which the tax was deductible to the date of furnishing the return of income. And when the assessee is treated as assessee in default, again, the same interest rate is there, which is 1% from the date on which tax was deductible to the date it is deducted, and 1.5% per month or part of the month from the date on which it was deducted to the date actually paid. Time limit for passing the order for treating the assessee as assessee in default is 6 years from the end of tax year in which the tax is deductible or collectible, or 2 years from the correction statement delivered. This remains the same. There is no change in that. Then the 399 is the processing of the TDS TCS return, which talks about all the statements of the TDS TCS, including the correction statements, shall be processed in the manner to identify that the amount deductible or collectible which are there, in that the adjustments may be made for any arithmetical error, for any incorrect claim apparent from the record, right? And then basis that the amount shall be determined to be payable by the deductor or collector, or the amount of refund which is due, intimation shall be prepared, and basis on that the amount of refund will be collected, and the intimation will be sent within 1 year from the end of the tax year in which the statement is filed. Again, this remains the same as it was in the earlier act. What is incorrect claim apparent from any information? Again, it is defined in section 402, which says incorrect claim from the statement information in the statement shall mean a claim on the basis of an entry in the statement of an item which is inconsistent with another entry of the same or some other item in such statement in respect of rate of deduction at source or rate of collection at source, where such rate is not as per the provisions of the Act. So this has been defined again in section 402. What do we mean by incorrect claim apparent from the information in the statement? So more or less, as I said, that all the provisions remain the same in terms of the substantive changes that have been carried out, except this one major change in terms of the correction statement timeline, which is now 2 years from the 6 years. Rest, the thresholds, the tax rates, the definitions remain the same. What has been changed is the structural composition as what we had earlier and what we have now. But having said that, I'm again and again emphasizing, because it's very important and we may make a mistake not to look at all the provisions of 393. So when we read 393, it is very essential that we also read the footnotes, we also read the table 4, and we read it along section 402 to advise correctly. So with that, I would like to end. Yeah.
Actually, the PPT was blocked.
It's visible, right?
Yes, visible, ma'am. Yes.
Yeah.
Actually, it was blocked from section 339.
339. No, there's not 339.
No, I may have mistaken. 399, sorry.
So that's the last section.
Okay.
Yeah.
Is it
So
done, ma'am?
yeah. I'm done. You can take the questions if we have some.
Yes, ma'am. Considering the complexity of the topic, there are many questions. So I will request you to take it in short so that maximum of the questions can be taken.
Sure.
There is a question from Jabalpur. If the assessee wish to carry forward the TDS for subsequent year while declaring the income in uploaded return for the assessment year 25-26, can he do so and claim TDS in the subsequent year?
Yes. So, as I think it was mentioned earlier by Vasanta sir also, that the saving clause allows you to do that. So, basis that you can take the carry forward. So, the Income Tax Act, even though it is repealed, but the section 536 does not prevent any right, privilege, or obligation which had accrued to you under the earlier act. So by the operation of the saving clause, you could, if you've carried forward any TDS credits or TCS credits, you can of course claim it in the next year when you file for the Income Tax Act 2025 return.
Thank you, ma'am. The next question is on payment to non-resident partner, whether TDS to be deducted under 194T or under section 195, which is as per Income Tax Act 61, which is now subsumed section 393 as a whole.
Yeah. It's a very interesting question. So, ideally, if you look at the erstwhile act, it didn't override with, some notwithstanding clause or something like that. And it just said that any firm which is there, which is making the payment to a partner of the firm. Now, that being a more specific clause, according to me, should operate over 195. And even we can evidently see that, wherever the payments are in the non-resident, they are covered here in table 2. And for any other, it is covered under table 3. So, in that particular case, it should operate under 194T in the erstwhile or in the table 3 here.
Okay. Okay. Ma'am, the next question is TDS to be deducted by e-commerce participant, that is for restaurant services, towards fee and commission charged by e-commerce operator like Swiggy, Zomato? Two, do TDS deducted by e-commerce operator on turnover under section 194O on the taxable turnover? Kindly advise on this.
So, can you repeat once?
Ma'am, is TDS deducted by e-commerce participant towards fees and commission charged by e-commerce operator? It is related to section 194O, the turnover under section 194O. Even the question is not clear.
Yeah, I think so. But what I'm understanding from the question is that there's some fee or commission sort of charged by Swiggy Zomato to the e-commerce participant. You mean maybe for listing or something? So that you have to refer to the FAQs which had come for that, wherein they have said that every e-commerce participant has, like, there are two e-commerce operator, two e-commerce participant. In that case, they should have an agreement in between that who should be deducting the tax. So in that case, if an agreement is there where you are not able to decide that who should be ideally deducting, then the liability can be put on the e-commerce operator, who is the principal e-commerce operator, to deduct it. But generally, e-commerce participant doesn't have to deduct. If there's an e-commerce operator who is mainly facilitating everything, then in that particular case, he has the principal liability. But you should refer to the FAQ because the question is not very clear in that sense.
Okay, okay. Ma'am, the next question is, currently a person can identify what kind of income is received from 26AS when the income is reported in particular section. So far as new act is concerned, when everything is covered under one section, how would a person come to know what kind of income is reported in his form 26AS?
It will be some kind of, this, like the way we had 26 years earlier, it would be some sort of, scheme which will be developed for this, or maybe the same thing would be, put up as a rule for this as well. So you would be able to know even under the new act.
Okay, okay. Thank you.
Because all the rules
Uh,
and notifications will be duly, notified in that sense to just have the smooth workability of the act.
Thank you, ma'am.
Yeah.
The next question was, please explain the deadlines for filing correction statements to be done before 31st March 26
Yeah.
related to TDS.
So all the correction statements which are there, so for the 6-year window which is there, when for the years which is getting closed in on 31st March 2026, so I think for 2018 onwards, so those years have to be closed because this operation which is there for FA 2025 will be 2 years, but this 2 years will be in a retrospective way. So once this 31st March 2026 period ends, then you would not be able to rectify for 2018 and all those years. So that is in relation to that 31st March 2026 timeline, which is appearing that 6 year is for the past years, but after that the 2-year time limit will operate.
Okay, okay. Ma'am, there was a question also related to portal. Will there be any changes in portal also, considering the changes in sections and act, traces portal specifically?
They may have to, because considering how the new sections are, the new statements would be furnished in line with that. So they would undergo, all the e-filing portals would undergo a change by the next year. I'm assuming that here.
Okay. Ma'am, the next question is, okay, whether TDS is applicable on interest paid on term deposit by cooperative bank to other cooperative housing society under the new act.
So everything in terms of the old act and the new act remains the same in terms of the exceptions which have been notified. Now, in terms of the cooperative society making the payment to another cooperative society, it is not having any TDS. But when a cooperative bank pays to a cooperative society, in that particular case, what the earlier act also used to provide is that, sorry, yeah. So in that particular case, also there was this provision which said that any income which is paid by a cooperative society to its member, which is other than the cooperative bank, in that case, the TDS will not be applicable. So when a cooperative bank pays to its member cooperative society, there will be TDS which will be applicable in that particular case. Yeah, but in a case where the income is paid in respect of the deposits with a cooperative society, again, which is not a bank. In that case, also the TDS is not applicable.
Okay. Ma'am, the next question is, the tax paid through challans have been paid for the assessment year 26-27, but new income tax act shall consider tax year, which is 25-26. So how the credit of tax paid for assessment year 26-27 will be available to the assessee or deductors?
As I said, 536 reserves your right, the saving clause in terms of all the rights that you have in terms of whatever taxes that you would have paid in the past, whatever losses that you have incurred in the past, all that will be available to you in the new Income Tax Act.
Ma'am, the next question is, we are a consultancy firm based in UAE with no establishment in India. We have provided consultancy services to individual resident in India. We would really appreciate if you could provide clarity on whether any deductions are to be made on fee being remitted from India.
It depends on the facts of the case. It depends on contracts because India UAE also does have the make available clause in the treaty, how the basically contracts are worded, what kind of consultancy is it. So it depends on those factors, whether it is concerning any business in India, whether it is not concerning that. It depends on all those factors to answer that whether there will be TDS applicable or not, because first we need to examine its taxability, then only we can examine the TDS applicability in that sense.
Thank you, ma'am. There is a next question. Is TDS needs to be deducted on interest payment to financial institution even if interest payment made with EMI? How we can recover this TDS from financial institutions?
So in that particular case, see, you would have to have, like, when you deduct the TDS, why would you want to recover it from as a payer of the TDS? You are required to, deduct and make the payment. Now, the problem arises because you are making then the full payment of the EMI, which will be like entire interest component without deducting the TDS. So some sort of financial institutions have this arrangement where they give this credit against the future or the last EMIs which are there. So that sort of arrangement needs to be developed with them to prevent that. Apart from that, if these are like government companies, in those cases you have to check that whether these financial institutions are government entities or centrally incorporated, so then the TDS will not be applicable at all. So you need to check that as well.
Okay. There are still many questions, ma'am, but going towards the last question, under the existing section 195, tax has to be deducted only if the income is chargeable to tax as confirmed by Supreme Court. Please confirm the said position, whether the said position remain the same under the newly introduced section 393. If
Absolutely,
there are
it
any
remains the
material
same.
changes, please share.
It is absolutely remaining the same because even the current law uses the word sum chargeable to tax, which essentially will retain the Supreme Court's ruling to say that it is only on the sum which is chargeable to tax and not on every sum. So only on the income component, you need to deduct the TDS and not on every payment that you make.
There are still many, ma'am, as I said, but the time is running short. And
Sure.
with the past 1.5 hour session of yours, the TDS, that is TEDIOUS, has been now TDS, easily tax deducted at source. So thank you for that.
Thank you.
With this, I would like to end our session with formal vote of thanks and will like to express my gratitude to the Direct Tax Committee for providing me an opportunity to me and all the members from over India to hear about the new sessions. To the chairman, sir, Piyush Shajed, sir, of chairman of the committee, to Vishnu Kumar Agarwal, sir, vice chairman of the committee, to the representative from the department, that is Vijay Babu Vasant, sir, to the speaker, Prerna ma'am, and to all the members who have joined us from all over India. Thank you, one, thank you all, and keep joining us for the next session. Thank you, ma'am. Thank you.
Thank you so much.